Welcome back to the IB Investor channel. In this video, we'll go through Sinch most recent earnings report, which is the Q2 2023 and not Q3. That will happen in a few days here. So in this video, we'll cover the share price development, we'll cover the sales development and its profitability, we'll go through the cash flows, the debt situation, and if there is any short situation for the stock. Now for the share return of this company, and I think it paints a two-side story where some investors who climbed on early made great returns here, granted that they sold the stock on the way up. And then we have the other picture then with the shareholders buying into the stock at the top levels, probably somewhere around here, and they lost a ton of money. I would say if you held the stock from this period here, from the start going all the way up here, you made more than 26 times your money. So the stock has been a great return for many investors who held it from this period here, or even here, you made a lot of money here going up. But investors who bought in here and held it today have lost more than 91%. So basically they eliminated all the capital that they had if they invested here, pretty much. We can also see here for the overview that if you held it for the long period, you actually doubled your money for this whole period. So, for the long term, you still made some money. Even for the 5-year period, you made some decent money considering the bear market that we're in right now. Or actually, I don't know if we can call it a bear market, but yeah, you at least made some money here, which is actually quite decent. I would say 70% is nothing bad in this environment, certainly not. But for the remainder of the periods here, 3-year, 1 year, year to date, 3 months, and so on, you most likely lost money because the stock has just been, it's been brutal. The stock has just gone down and down. It's also one of the more commonly owned shares to hold at my broker here. So roughly 72,000 shareholders right now of the stock. Now for the income statement for this company, I had to remove the EPS once again because the EPS were so sloppy it would have made this picture much less understandable. So yeah, it is what it is. But anyways, we'll start with the net sales. So we can see that this company has actually had a quite decent development in terms of net sales. So here pretty much it doubled here almost, going only 2 years, and then from 1,000 up until here it's like 4x. So this company had great sales, from the starting period here, and even here it's still doubled, you see. So this company has had a great sales development when you just look at the net sales. However, for the gross margin here, it's been pretty low, I would say. So we can see that the gross margin here, currently it sits at 34.2% here for the most recent quarter, which isn't that much, to be honest. I would have expected this company to have much higher gross margins than I have right now. Looking at the profit margin right now, we can see that it's in the red here. So currently it has a profit margin of minus 18%. So this company is not making any money on the bottom line right now. And it's been negative here for 2 periods in a row. So that's actually pretty bad for this company. But even when the profit margin were good, as you see during this period, it didn't provide more than 4 to 5% profit margins here in percentages. So it wasn't that good, but it's all because of this that the gross margin is actually quite low. I mean, even here at 34%, that's like industry margins, which it's not super bad, but it's not super good either, and it just makes it so that there's much less potential on the bottom line when you have these kind of margins, which we can see here, even for these periods here. Now for the EPS and the P/E ratio for this company, starting with the EPS or earnings per share in blue, we can see that it's been positive for quite a few years here. It's only as of the late or most 2 recent years it's been negative. So for the most recent quarter here, we can see that it's been negative 6.1 kroners a share for the rolling 12 months, and here also in 2022 it was negative. So they've had a bad period right now where it's just been pretty bad. And we can also see the P/E ratio here as high as 211 here in 2020. So this just screams overvaluation in terms of P/E ratio, at least And also this here, we can see that it traded at 64 times, and here 91 times, which is just massive. But also historically speaking, looking back here a few years too, certainly these 2 years it looked really overvalued from a P ratio point of view. But then again, P ratio isn't everything, so it's just one of the metrics that you can value a company by. Now for the free cash flow margin, looking at the most recent quarter here, Q2 and rolling 12 months, we can see that it sits at 4.3%, which isn't bad. And we can see that it's been 1 year here in the past where it's been positive as well. But for the remainder of the years, you have to go back to 2015, where you could see the company posting a positive free cash flow margin here, which is pretty bad. It's really tough to value a company that just provides negative after negative free cash flow margins. And also comparing it here to Nokia, that sits at 4.2%, and Ericsson at minus 0.4%. So peers aren't really trading at much higher free cash flow margins either. Now for the free cash flow, in terms of kroners per share, we can see that for the most 2 recent years, as we saw in the previous slide, it is positive. So here's 1.5 kroners and 2.2 kroners, but the remainder here during this period has been negative, except for the first 2 years here, 2014 and 2015. It currently trades at somewhere like 8.8% free cash flow yield, depending on where the stock stops trading today, but quite a high free cash flow yield actually, considering what the company looks like historically speaking then. Now for the cash flow overview. So here we can start with the operating cash flows in blue. It's pretty hard to see here because the figures were so low, but it's been growing here, at least for this period, going from 50 to 300 to 327, 400. So during this period, at least, it grew pretty nicely, I would say. Also here, we can see that it did grow quite a lot, but we can see here for the capex here, for the investing side of the business, they plowed down almost 3 billion Swedish kroners here in 2020, and following year 2021 they plowed down 29 billion Swedish kroners, which is massive. Just looking at the previous cash flows, this amount is just crazy. It's so much higher than it doesn't even cover all the cash flows that they had from operations in the past combined, unless my calculation is wrong. It could be wrong, but they made a massive acquisition here, and I think they're paying for it right now, because I think I read somewhere that they had to write down all the assets from this acquisition. So this was a bad acquisition from management here. They made a lot of capex here that it wasn't good for shareholder value, certainly. And now we can see here it's been much less spending, which is good to see, because they failed here basically. And now we can see we're down to 700 million. However, the cash from operations hasn't really improved much here, so they went down actually here from 2022 to the most recent quarter here by almost, 600 million cash from operations less from 1 year to the other. So not so good. The cash flows are quite weak, especially in terms of this acquisition here. I would have liked to see at least the cash from operations continuously going up, at least, or growing, but yeah, it is what it is. Now for the net debt in blue here, and comparing it to cash flows, just to see how the financials looks like. And we can see here again, they made this huge acquisition here during this period, and we can see that they financed most of that acquisition with debt, as we can see. So they didn't have any debt here during this period. As you can see, it's negative. So they actually posted more cash here during this period in 2020, which was very good. But then management, they made some bad acquisition here, and now we can see that the debt is massive. So just comparing this one to this one, it's like it's like 30 times or something. Maybe my math is wrong here, but massive change here in terms of how many years the cash flows would take in order to pay off all its debt. Here pretty much paints the same story. It's just less than 4 times cash flows in order to pay, maybe 3.5 or something like this, 3.7, in order to pay off the debt here with the operational cash flows. And here it's even more, 5 years or something like this, comparing this number. So here it's actually a bad situation, because we can see that the net debt is actually going up whilst the cash from operations, as we saw even on the previous page here, is actually going down. So this is not what you like to see, that the gap is increasing here between the net debt and the cash from operations. So management must do something about this net debt, because 5 years to pay off the net debt is too long in my book. Maybe 2.5 years, 3 years max, but not more than that, or you risk the business. Now for the net debt to EBITDA, and we can see here again, it pretty much paints the same picture as the previous one. We can see that the acquisition made this company's financial situation much worse here. We can see that it currently had a multiple here of almost 13, which is the highest I've seen for the companies that I've made videos about so far. We can also see here during this period, it's also quite high still, 3.3 times, 3.1 times for the most recent quarter. So not very good. It's much better to be in this situation, especially negative here, where they actually had more cash than net debt. So certainly they have to come back to this situation. This is where the best feeling is for management, when you don't have to care about your financials in the same way. Here you have a lot of financial stress in your system, and this is super bad. But it has been reduced here, but it's, it needs to come down. I would say, 1.5, 2 times or something like this is, for any company, a better level, comparing it to this at least. And then we can also see some peers here. So Ericsson at 0.3x, which is very low. And then we have the opposite here, where Nokia has more cash than net debt. So multiple here of minus 0.6 times net debt to EBITDA. So Nokia is a much better financial situation, just comparing it apples to apples for this KPI, nothing else. Again, now for the EBIT to EBIT, and yeah, pretty much as we saw on previous pages, like this year was crazy, 2021, and here we can see that the EBIT to EBIT multiple here, 427x, which is just, it's crazy amount here, I would say. We can also see here that it's actually traded at quite high levels. Anything below 15 or something like this, even if it's a growth company, I mean, that's more fair, but still this company has had many periods here where the EV to EBIT multiple or ratio has been very high here. And it's probably, during this period, it's probably been the highest here I've ever seen so far. But anyways, during my short period here as well, this is the second company here where we can see negative EV to EBIT multiple. The second one was Fingerprint here, and as a reminder, as I mentioned in that video, is usually not a good sign for investors, as it indicates that the company is either unprofitable, over leveraged, or underappreciated by the market. However, some investors may see this as an opportunity to pounce, that maybe the company is trading at bargain levels or bargain prices. If you believe that the company has a strong growth potential or hidden assets or something like this, it could be a good opportunity for shareholders looking to buy this stock. But I would be careful. You have to make sure you do good research here, because it's, in my book, never a good sign when it trades at a negative, or when it has a negative EBIT to EBIT multiple here, as we can see here for Sinch. Now for the short interest of the stock, and yeah, as you can see here on the right side, in terms of all the float, more than 11.5% is being shorted right now. So this is one of the most shorted stock on the stock exchange in Sweden right now. And I think it ranked somewhere like 4 or 5, if I don't remember incorrectly. So very high shorted stock right now. And comparing it then to SBB, that sits at 17, it is quite close, and especially here the second one, 15%. So investors should be very careful here. Because this means that 11.5 or 11.6% of all the float is being shorted right now, which means that those investors who are shorting a stock have a completely different idea where the stock should be moving. And in this case, they want the stock to go down, because they probably have some theory or thesis, or maybe inside information or something like this, and maybe they know something about the company that the rest of us don't know. So it's always a big risk, I would say, going against a stock which is highly shorted in this case. So you have to make sure that you do good research here, so that you have a lot of meat on your bones when you're investing in this company, or if you're already holding the company, basically. Now for the CEO remark for this company, and I think it's very important here where she highlights some improvements in margins, for example, and some extraordinary costs here in 2022, which is the comparable year here or quarter. But when I look back, I had to check this myself because this is a summary, I might add. It's not the actual letter, but rather a summary. But I saw here that the gross margins, when I looked at the income statement here again, was up some 7% year over year, so that's correct. The operating margin was also up some 2% year over year, so those type of margins were actually up, as I agree with her or the CEO. But the profit margin, when I looked, I could be wrong here, but it looked like it was down 0.4% year over year, so the profits were actually down in terms of margins. So, you know, I wouldn't dance yet as an investor, you know, to cheer up that everything is going well, because, you know, the profit margin by the end of the day, that's the bread and butter for the investors, you know, holding this stock. Just having a gross margin and operating margin positive just means that you can, you know, continue running the business, but by the end of the day, you want the profit margin to happen as an investor. Anyway, sorry, I digress. She also acknowledges here that they have some challenging markets here, where some, you know, with lower volume growth, which impacted the messaging business negatively. But however, the CEO is optimistic here, sorry, to gain some market share by offering a broad range of communication channels. So at least I like that she's highlighting here that they have some issues here, that they can see that they have some volume or lower volume growth. And I like when CEOs are honest and upfront about, you know, that everything isn't so well under the hood. So that's kudos to her. I like it. She's also saying here some enthusiasm for the potential to create more value for customers by bringing together the strength of different business units and building a stronger and more unified Sinch. Yeah, I mean, that's good. But anyways, we'll have the Q3 report pretty soon here. It's going to come probably in a few days here only. So we'll be able to cover the numbers and compare the numbers a little bit better than to see, because this is a tough and challenging year, obviously, for this company. And they really have to turn around the cash flows. As I mentioned previously on previous pages here, the net debt is spiraling out of control, and they need to bring down the net debt along with, you know, improving cash flows here for rolling 12 months. So it's going to be very interesting to see how they will offset those increased costs without, you know, driving higher net debt or something like this. And as investors, we really need to see that the cash from operations at least are improving here in the coming quarters. Now, this was it for this video. If you liked the video, please hit the like button below and subscribe for more content. Thank you. Bye-bye.